Good day, everyone, and welcome to our lesson number 25, which is a continuation of chapter 6, Cost and Pricing. So, this is Majia H speaking. So, we're going to be doing fixed and variable cost, which is a continuation of chapter 6, where we left off previously. So, under today's lesson, we're going to be covering page 259 to 273. So underneath it's a link that you can also use as a recording to watch to also gain more understanding of the concept of fixed and variable cost, especially the break-even point analysis. So it is always important that you attend all your classes regularly. The most important other one is to make sure that you complete all the activities. So every activity that I'm going to mention here under this lesson, please make sure that you go and try and do them so that you gain more understanding in terms of the concept of fixed and variable cost, so that you don't get to be confused when we move forward with the lesson. So today's lesson outcome is going to be based on the following concept: that by the end of the lesson, you should understand the meaning of fixed and variable cost, differentiate between fixed and variable cost, and another thing is that you also need to be able to identify in terms of production cost which of those variable costs will fall within production and which will not fall within production, as well as same applies to fixed costs. There are fixed costs that are involved in production or that arise because of production of a product, and then there are those fixed costs that arise as part of operating the business. So you also need to be able to identify those under this lesson. And then we're also going to talk about the break-even analysis. I also refer this as BEP, break-even point analysis, and understanding the concept of CVP analysis, which is cost volume profit analysis, which is all based on the break-even point analysis. So this is what we are going to be covering today. So before I actually get to mention a lot in terms of before I start with the lesson, I'll just start to elaborate more in terms of this concept that we're going to cover today. So in terms of our accounting world, we've got two concepts. We've got accounting and we've got finance. So with these two, under accounting, we've got financial accounting, and then this side we've got managerial finance. So based on the two concepts define a way that this one we use it for decision making. And this one we use it for reporting. So with the two accounting standards, or with the two concept in finance and accounting, so we've got the accounting and we also have got the finance, where the finance we use it for decision making and then the accounting we use it for reporting purpose. So earlier on in our lesson, based on lesson number 1 up to I think lesson number 4 or 6, things between lesson number 1 up to lesson number 10, most of the accounting concept we're mostly focusing on were accounting concept, the reporting one, the recording of transaction, preparation of financial statements. All of these are accounting concepts, so they fall within the accounting field. So we call those financial accounting concept. So from 2 weeks ago, we started with what we call the finance concept, which are the managerial finance concept. So these concepts are relevant in terms of each and every field because we use this for decision making. So for us to be able to be profitable, we're gonna use the managerial finance concept to analyze our business financial standing and be able to take a decision. So finance, it's all about decision making. So under this stage where we are currently on the previous lesson, we did what we call financial ratio analysis on chapter 5, or financial statement analysis or interpreting financial results. So this is all done under finance. But people who prepare the financial statement, we found them under the accounting. So those are under accounting concepts. That's where we prepare the reports, the financial statement. But when it comes to analysis, it's the finance department that does the analysis. So if you're going to become a manager, you also need to be able to take financial decisions. So under this topic, we'll be taking a look at some of those concepts, being able to assist you to be able to identify what are what do you need to focus on for you to be able to make the right decision in terms of the business processes, production, as well as revenue generation. So in terms of this activity or this lesson that we're going to cover today, it's going to be mostly focused a bit on where you actually have got a physical product that you're actually selling. But the concept still applies to services rendered if you are rendering services. So if you are rendering service, you're also gonna need to be able to identify all of these concepts that we're going to cover today so that you can be able to make decision in terms whether you are going to make enough profit or you still need more product to be produced and what is the cost associated with all of those. So this is what we are going to be actually learning today. So we're going to be covering managerial finance, but under this managerial finance, we are going to be covering the concept of managerial finance called marginal costing. So this concept of marginal costing, it's what we use for decision making. It's based on the concept that when we make decision in terms of product or services that we are going to render, let's make decision based on variable cost. So we make decision based on variable costs. And then there will be what we call fixed costs. So what actually happens is that when it comes to these two type of cost, when it comes to decision making, the most relevant that we are going to consider will be mostly the variable cost, because this one will tend to change based on the number of activities that are being performed, whereas the fixed cost will remain constant whether we produce or we don't produce, or whether we render service or do not render service. So this kind of cost will remain the same. So when it comes to marginal costing method or concept, when it comes to decision making, our decision mostly is based on variable cost. So this is what we are going to be learning today. And therefore, this cost will also be linked together with the fixed cost. The fixed cost will be used to identify a point in which we're gonna have what we call no profit or lost after rendering a number of service or after selling a number of product. Whereas in accounting, we've got something called the absorption costing. So with the absorption costing in terms of financial accounting, this is the one that you guys are familiar with. So with the accounting concept, we cannot use it for decision making because it gets to also include some of irrelevant cost in terms of production cost. It also include our fixed cost under production cost, which then makes it a bit difficult to actually justify whether this product is actually going to make us money or not, and then if the costs that are associated in products producing this product, which one are relevant and which one are irrelevant. So it becomes a bit challenging under the absorption costing. So absorption costing is your normal one that says sales, cost of sales, and then here it's gonna give you your gross profit, and then you're gonna say add income, other income. So this is normally your income statement. So absorption costing, it's your income statement, whereas marginal costing, it's a differentiation of income statement. We break down everything based on the two concepts, variable as well as fixed cost for decision making purpose. So under this lesson, this is what we are going to cover. So let's go inside now that we have got a bit of view in terms of what we're going to do today, and how does it differ from what you already covered in the lesson, and how does this actually help someone who's actually in media to actually get to understand their business in terms of revenue generation, whether this year you are actually going to make profit and when do you start making that profit. So we're gonna also get to assess this under this lesson. So in terms of this lesson, we're going to first start covering the fixed and variable cost. which we refer this as the cost behavior. So for us to be able to identify something that is a fixed cost or it's a variable cost, we need to study the behavior of that specific cost. So here it says that one of the main tasks of cost accountant is to work out how costs change when the volume of production changes. So here it says that cost behavior refers to how costs will react or respond to the changes in the level of business activities, and where costs remain constant when the business activities are being performed, and the cost remain constant no matter the number of production rendered, the number of services rendered. We're gonna refer this to fixed cost. So here they've identified fixed costs as: fixed costs are the expense which must be paid irrespective of the volume of production. Example will include rent, property rates and tax, as well as insurance. So when it comes to building insurance, when it comes to property insurance, when it comes to rental amount that we are going to incur, all of these will have to be paid whether we produce units or not. So if we're running a factory, we're still gonna pay factory rent, which that factory rent, whether we manage to produce units or if we have breakdowns, it doesn't matter. The owner of the building will still require rent. So those will be classified as what we call fixed cost. And then any cost that we're gonna incur because units were produced, therefore we're gonna classify that as variable cost. If we render any service and there is a cost that is coming up or that we incurred because we tried to render a service, so that will be a variable cost. So in terms of fixed cost under rendering service are those costs that will incur no matter what, whether we render the service or not. So still applies office rental, property taxes, insurance on our equipment, whether we render service or don't render service to our customers, this cost will still be there. Same applies to when it comes to variable cost, it doesn't apply the same way. So in terms of variable cost, this cost will go up and down based on the number of activity we perform. If we render 10 services, the cost will go up based on the number of those services we render. If we render 5 services, the cost will differ from the 10 service because of the number of services rendered. So in terms of production, if we're going to produce a number of units, this cost will go up and down based on the number of units. So here it says variable cost are expenses which will vary more or less proportional with production. So meaning that the more production goes up, we expect it to go up. The more production goes down, we expect this cost to go down. So here it says if production goes up, the total variable cost goes up, and in the same proportion, and vice versa. So this is what we identify as variable cost. So variable cost will actually include things such as direct material, direct labor, and direct overhead cost. So in terms of overhead cost, I'm referring to machine cost. Machine cost, I'm also referring to setup cost if your machine have to be set up. I'm also referring to what other costs could be involved? Electricity cost, which is associated with the usage of the machine. So all of this will other form part of machine cost. So all of this can be included within the machine cost, which is going to be the direct overhead cost, which is also known as variable overhead cost. So this is also known as variable overhead cost. And then here we've got direct labor cost. So all of these costs, we refer them as variable costs. The only reason we refer them as variable cost because if we don't produce any product, we're not gonna incur material cost. We're not gonna incur labor cost for assembly of the product. We're not gonna incur electricity cost or machine setup cost because there was no production. But the moment there is a production, when we have to produce 1 unit, we're going to need material, we're going to need the labor, the person who's going to assemble, we're going to incur electricity cost or machine setup cost, all of these type of costs that are related to the machine. So those variable overhead costs, we're going to incur them because the machine will have to be set up so that it managed to produce the item that we are trying to produce or the product that we are producing in our business. So we refer this as our variable cost. So then this brings us to the concept of break-even analysis. So the break-even analysis comes from the concept called CVP. So CVP means cost, volume, profit, analysis. So this is what the concept comes from. It comes from the concept of cost, volume, profit analysis. So this concept can be given in a way of a triangle, to say that we have got a triangle that looks like this, to say that we're gonna try to produce a product. So we're gonna have cost. So we're gonna have cost. When we have got the cost will depend based on the volume of product that will be produced. And from the volume of product, this will therefore give us what we call the profit that we are going to generate. So it's sort of like a triangular method, CVP. So this means that for us to be able to generate revenue, so therefore you can either put the V here. In some cases you find the V placed here and then the profit here, to say that the difference or the cost that will give us profit will be the volume that have been produced. So lesser volume, lesser profit, higher volume, higher profit that we're gonna actually get to generate. So this is what we call CVP. So it's based on the concept that you're gonna incur cost and then you're gonna also have number of services. So the volume refers to either product or services. So if your business is rendering service, you'll have to identify the number of service that you're going to render, and then from the number of service you're gonna also have the cost that will be associated with rendering the service and then the profit. But in terms of manufacturing of a product, therefore you're gonna have a number of products that are going to be produced, which is gonna lead to your cost and therefore the profit that you're going to generate after selling those products. So with the concept of break-even analysis, so what we are trying to achieve is to say that let's identify the point in which where our total revenue will actually be equal to our total cost. And remember, so we are saying that TR, which is total revenue, it's equal to total cost. And remember, total revenue, where total cost is our fixed cost, our total fixed cost plus our total variable cost. So all of these combined gives us what we call total cost. So we are trying to identify a point in which when our total variable cost will be added together with the fixed cost, and this will actually be equal to our total revenue, meaning that once we identify this point, therefore we can be able to identify the number of units, to say that from this point how many number of units were actually produced, so that when we have got our total variable cost and our total fixed cost combined together, this will equal to our total revenue, so there won't be no profit or loss. So total variable cost will be based on number of units. So with the break-even points, we are looking for those number of units, and from the number of units, we can then identify the total revenue that will actually be made when this number of units are produced, and therefore we're not going to have any profit or loss. So this will be equaling to 0. So therefore, once we have got this number, so when we are actually working during the financial period, when we are actually preparing our financial statement or our budget, we do know that once we reach this number, we are now at what we call a break-even point, to say that any number of units that we're going to sell after this, we're going to therefore be actually starting to make profit. But we don't actually just start by making profit at that point. So we've got something else called the margin of safety. Margin of safety is a number of, as a percentage in terms of after our break-even point, to say that this is the number of units that we need to produce so that we do not make profit or loss. but anything after that we're going to make profit or loss. So sometimes we find that the margin of safety is 20%, to say that we need to sell at least extra 20% of this amount, so that we can say that from after the 20% we have started to make profit. So in an example, so with an example, I will say that, to say that we are going to have a break-even point at 1000 units. So meaning that if we sell 1000 units, so let's assume that this is our BEP before I go to reading the slide. So this concept is to say that if we're going to sell 1000 units and we do not have any profit or loss, so this means that our total revenue will be equal to our total cost. And remember, total cost is our fixed cost plus variable cost. So when it comes to this concept, we are saying that we still have got what we call margin of safety. I'm just going to write MS. So it's called margin of safety, to say that from this point, we cannot just actually sell 1000 and assume that we're going to actually get to then start making profit after 1000 units. So because there are changes in the market that will actually get to happen, to say that, and maybe material cost might go up, there might be lesser demand in the market than what we anticipated because of technological changes that might happen. So therefore, we might find that we're going to add 20% of this. So 20% of that will be 1200. So this will be our margin of safety. So meaning that break-even point is 1000, margin of safety is 1200. To say that once we sell more than 1200, we can then say now we've made actual profit. We are going to be making actual profit because now we've passed our margin of safety. So all of this in a graph, it will look something like this. So it will look something like this. So this will be units, this will be cost plus revenue. So under this point, our cost under this point, so this will actually be our total revenue. This will be our total cost, and this will be our variable cost, this will be our fixed cost. So fixed cost will remain constant all the time. Variable cost will start from zero because the moment you start producing product, therefore we expect this cost to go up. There will be a certain point where fixed cost and variable cost will be equal, but that doesn't mean that we are at break-even point. The only time where we're going to be at break-even point, it's only when we have got the total cost. So total cost for our product will start here, to say that since we don't produce any product, our total cost will be equals to variable cost, which is 0 plus the fixed cost. So therefore our total cost will start at the point of fixed cost. And then once we start producing, we're going to add the variable cost plus the fixed cost, and then we're going to have a total cost somewhere up here, because now we're adding total cost plus fixed cost. So the gap in between the fixed cost and the total cost becomes our variable cost. So therefore we're going to have this total cost line going here, and then we're going to also have got our total revenue. So then now when we don't have any units being sold, we're not going to have any revenue. And then once we start having revenue, this will therefore go up by the number of units we actually sold. So here, since we're going to be having our total cost, where our total cost meets our total revenue, to say that we have got a total cost that is equal to total revenue. We have sold maybe 1000 units here, and then here the total revenue, it's actually, or the total cost, it's 6000. So we have manufactured 1000 units and we have sold 1000 units, and the total cost and total revenue is all 6000. So we have reached this point, so we haven't made any profit or loss. But the moment we start selling more than 1000, we start saying that we are now operating at a margin of safety until we pass 1200. So 1200, and 1200, find that it's 8000 profit or cost of sales. So it's 8000 in terms of profit, and then in terms of cost it will be somewhere around 7000. So to say that we have made a profit of 7000, I'm going to show you this through a graph that we're going to use on the book. So this is what we call gross profit break-even analysis under the cost under the CVP concept. So meaning that here, this is what we call our margin of safety. Anything above these 1,200, we say now we are actually making profit. So this is the full concept of break-even analysis. So let's go to our lesson and see what we have in terms of our lesson. So here it says that break-even analysis, the main purpose of many enterprise is to maximize profit, and in a manufacturing environment, this is done through what we call cost-efficient manufacturing, where we try to minimize the cost as much as possible, and therefore also in terms of selling the goods that we actually produced. So it continues to say that profit is the amount by which the total sales exceeds the total cost for a financial period, whereas the loss is whereby the total cost exceeds the total income from sales. So break even is a concept which describes a situation where neither profit nor loss is generated. At this point, the income generated from sales will equal the expense incurred. So break even analysis can be also called cost volume profit analysis in some cycles or in some cases. So in most cases on our side in finance, we actually have a topic called cost volume profit analysis. That's where we then discussed break-even point, margin of safety, and all of those. So when it comes to this cost volume profit analysis, so cost volume profit analysis formula says that this is to say that profit it equals to total fixed cost plus uh, so here I'm gonna have to delete something a bit. So plus our variable cost per unit multiplied by units produced or sold. Let's just say units sold. So this is either our profit, our loss, or profit, but normally we refer this as profit. So profit is equal to total fixed cost. Sorry, this is total cost. Sorry, not profit. This is total cost. So this is actually total cost. Then from there, we're gonna then go and have to say that profit is equal to sales minus total cost. Then this is gonna give us profit, where our total cost in brackets, it's actually our fixed cost plus our variable cost. So this gives us the total cost. So with this formula written clearly, so I'm gonna write it here to say that profit is therefore equals to sales or revenue minus total fixed cost minus total variable cost, which then summarize as profit equals to sales minus total cost. So this is how we come up with the CVP formula. So this is what we call the CVP formula. So in most cases, when you read other textbook or when you go somewhere, you're going to have this formula being written down, where your variable cost will actually be then for be your variable cost per unit multiplied by units sold or produced. So units sold and units produced will have to be equal under this case so that we can have our profit. So this is what the break-even analysis concept it's all about. So here it says that break-even analysis, typically decision where CVP should be included to determine the break-even point. This is where we don't make any profit or loss. To determine by how much the expected turnover exceed the break-even point. To say that we need to identify when our turnover will start exceeding our total cost and then we start making profit. And then number three, it's assessing the implication of cost hike and reduction in profit. So it also allows us to assess to say that let's also put a margin of safety in terms of where we get to say that the cost might go up of our production. This means that our production, in terms of our break-even point, it might change and therefore be more units. So that's when we bring the margin of safety into place and say let's add extra 10% in terms of our break-even points, and therefore this will actually account for any hike in terms of cost. And therefore if there is a reduction in profit as well, therefore this will also get to cater for that, and therefore this will become our new break-even point. And then it's also assist us in decision regarding determination of the selling price. If our selling price is very low, our number of units or our break-even point will actually be very high, which means that we need to find a way in which we need to break even at a lower rate. To say that if we budget to produce 20,000 units and our break even is actually 16,000 units, so this is actually very high, so meaning that we need to find a way in actually to reduce this break even point in units. So this means that we need to at least find a way where we're gonna break even at 10,000, which is halfway, or either less than halfway, which is less than 10,000. Therefore we might actually have to increase our selling price. If we don't actually increase our selling price, we then have to reduce our cost. So when we reduce our cost, this means that we're going to have less cost. And when we have less cost, it means that our revenue will be more, will generate a higher revenue much better than when the costs are actually high. So this means that we can actually break even at a faster rate. So this is what CVP or cost volume analysis allows us to do. So it is for that decision making. So here it says that may be used to indicate the expected profit for various alternative, where we've got alternative in terms of different selling price, different supplier cost, because you might find that other suppliers supplying you your material at 5 rand, the other one at 10 rand, the other one at 11 rand. Your selling price will remain 210, 210, 210. So we're gonna perform a CVP based on all of these, and then each and every one will give us in terms of which one will actually give us a lower break-even point. So once we've got a lower break-even point, if this is the one that is going to give us the lower break-even point, then we're going to accept this supplier to actually supply us with the product. But before we accept the supplier, we also have to also determine in terms of if the supplier will be able to supply us on time and all of those. So therefore, those are other things that you will consider after you have accepted that when we buy the material at 10 rand, we're going to break even at a faster rate. So remember, we're still gonna have your variable cost, you're gonna still your labor cost, your machine cost, and this other type of cost might also depend in terms of the quality of material that you're going to use. So meaning that this material in terms of the supply of the material might affect the machine cost, because the machine will actually have to be set accordingly to the standard of material you are receiving. Remember, we've got grades of material. So if you are receiving low quality material, it means that your machine might have to, you're gonna incur what we call a higher cost in terms of machine setup, because you need to make sure that it doesn't break those low quality material that you're gonna use for your production. But if you get an average grade, let's say this is grade A, this is grade C, this is grade A, this is grade A, the expensive one, this is grade B. When you have got middle class material, you can actually have average cost in terms of machine setup and maintenance, because it's going to be using average grade material. So therefore, your machine cost becomes average and lower. But here, when you're using a higher grade, therefore, you're also going to make sure that your cost is very high. And when you're using a grade material, you find that also your machine cost will be very high, because you don't want to make any mistake, because the material is very expensive. So therefore choice B mostly become the best option, and then you get to calculate the break-even point and find that it's actually breaking at an even average or at a lower number of units. So meaning that once you sell 10,000 units, you break even, and therefore anything above that you start making profit. So these are other things that will be considered under the CVP analysis. So the concept of CVP analysis uses the following terminology. As I indicated, that the concept or the type of system that we are using, it's called marginal costing system. So this is also known as variable costing system. So if you're going to search this on Google, search variable costing system or marginal costing system, it will give you the same concept that we are actually covering here. So in terms of the concept of CVP analysis, first we're going to have marginal costing. So marginal costing, as I've already indicated here, it's also variable. So here it says that marginal cost is defined as the sum of all your variable costs, irrespective of whether this cost comprise of manufacturing, selling, and administrative cost. So this will all give us what we call our marginal cost. So these are all variable costs associated with producing the product and selling the product. But in terms of the full accounting concept, when we calculate these marginal costs, we're gonna have the one that are called manufacturing marginal cost or variable manufacturing cost and non-variable manufacturing cost. So which are all marginal costs. So this terminology, we refer this as well as variable cost. So this is the same as variable cost. So when we're working, we're gonna have something called variable manufacturing and variable non-manufacturing cost. So you can have the two types, the one that are related to manufacturing and the one that are not related to manufacturing. So for decision making, you're gonna have your sales less variable manufacturing. So this is the another accounting concept, in case you go and watch the recordings and watch other sources that will actually explain the concept. Then here you're gonna have then what we call contribution margin. So contribution margin is your sales less variable cost. It gives you contribution margin. And then once you then sales less again variable non-manufacturing, then you're gonna have your total contribution margin. So this is just contribution margin before the other variable non-variable. And then this total contribution here margin is the same as your gross profit in the other side. So we refer this that is the same as your gross profit. So this is the difference in between. So this one uses contribution margin, this one uses gross profit. But under this concept that we're going to cover today, we're going to be referring them based on their own concept, which is marginal, as well as we're going to refer them as marginal cost, as marginal income. So marginal income saying still applies as contribution margin. So we can refer this as contribution margin. So here it says that marginal cost, is defined as the sum of all variable cost, irrespective of whether this cost comprise of manufacturing, selling, administrative cost. So meaning that all the costs that are associated here, if volume or number of units goes up, this cost will also goes up. So those are the costs that you're going to classify as marginal cost. So here it says that it is useful because it incorporates all cost items which vary in direct proportion to volume. Like I indicated here to say that if volume goes up, the cost also goes up. And then we also have got marginal income. So marginal income is the income called marginal contribution. Is defined as the difference between sales minus your marginal cost or variable cost, which is this one above here. So all variable costs are set off against sales. That's accounting for items that vary in proportion to volume, proportion to volume of units produced and sold. So therefore, this will be your sales minus marginal cost. This will actually give you marginal income. So I'm just gonna write it as MI. So in another book, they will say sales minus VC, it equals to CM. CM representing your contribution margin. So, and then we also have got what we call a contribution, a marginal cost ratio. So a marginal cost ratio is expressed as a cost, expressed as marginal cost. Here it says that marginal cost ratio expresses marginal cost as a fraction or percentage of sales and can be calculated as follows. To say marginal cost is equal to your marginal cost over sales, this will give you the marginal cost ratio. So the marginal cost ratio indicates the proportion of every rand turnover that represent marginal cost. To say that for each and every revenue that we generated, uh, for every 1 rand, 40% of it is for every 1 rand revenue, 20% or 30% of it, it's actually cost. So it was made because of the following cost. So this is what it actually means. So here it says that if the marginal cost is 0.6 or 60%, it means that 60% of in the rand or in 60% of every rand in sales revenue comprises of variable cost. So this is the contribution towards the total revenue, to say that from all the revenue that we generated, 60% of that revenue is made up of the cost that we actually incurred trying to generate that revenue. So it is the contribution. So that's why we refer it as marginal contribution. How much did our cost contribute towards the total revenue that we are generating? So the marginal cost will actually be 60%. And then we've got marginal income. So the marginal income ratio, it says that marginal income ratio expresses marginal income as a fraction of or percentage of sales, can be calculated as follows: marginal income over divided by sales. If you remember that side, we've got gross profit. Gross profit is equals to your gross profit, it's your gross profit ratio is your gross profit over sales. So but this side we don't have gross profit, we have got what we call marginal income. So this one is the same as gross profit, but this time the terminology is marginal income, which is your coming from your sales minus variable cost. This will give you your marginal income, and then marginal income divided by sales, then this will give you the marginal income ratio, which is the same as gross profit ratio. So please make sure that you remember that part. So it says that the marginal income ratio indicates the portion of every rand turnover that represent marginal income. To say that from the revenue that we generated, 30% of that revenue is actually what? Our marginal income. So that's what the marginal income ratio actually explains. So here it says that another concept is the net income ratio or net profit ratio. So the net profit ratio, we've identified that it's the net profit over sales, to say that from the revenue that we generated, how much of that revenue is actually our net profit. So it says that the net profit ratios refer to the relationship between the total, the net income and the total sales. So it is important to note that the net profit ratio cannot be determined by working with unit prices, because fixed cost will distort the result, or should use only rand values when determining these ratios. So when it comes to this ratio, we're gonna use total revenue, and then also gonna use the net income. Therefore it will be our net income, net income, sorry about this, net income over what? Total revenue, all over total revenue. This will give us our net profit ratio, to say that from our revenue that we generated, how much of that total revenue is our net profit. So this can allows us to say that if we're going to estimate that next year we're going to generate a revenue of 100,000, and previously we had a net profit ratio of 10%. So we can calculate 10% of this to be 10,000, to say that we are expecting from this to actually make a revenue of 10,000 this coming year. So this gets allows us to be able to identify and predict our future net income in terms of the cost volume, that in terms of the volume of production that we expect to actually produce and sell in the next coming period. So that's what CVP analysis allows us to actually get to see. So to calculate the break-even point, we have got three formulas that are used to calculate break-even points. We've got a point where when we calculate the break-even point, we calculate it in number of units. How many units are supposed to be produced and sold for us to be to have to reach a point where we're not gonna make any profit or loss. and therefore to calculate that, it will be your total fixed cost divided by your marginal income. So this is where your income is actually equals to your total fixed cost. Sorry, it's equals to your total fixed cost plus your variable cost. So for us to be able to identify the number of units, so therefore it's your total fixed cost divided by marginal cost per unit. So marginal cost per unit, it's your variable. It's your, let me just write this down clearly. So the marginal cost, it's actually your what you call contribution margin per unit, which is the same as marginal income per unit. So under this one, this is your sales less variable cost, or what we call marginal cost. This will give you your marginal income per unit. So this is your selling price. So this is your selling price. So therefore, selling price minus variable cost per unit. This will give you your marginal income per unit. So you add all your total costs and then you get up to your selling price and your selling price per unit, and you subtract all of this, you're going to get your marginal cost per unit. You're going to take this marginal cost per unit divided with the total fixed cost to identify the number of units that are actually supposed to be produced. And then to calculate break-even points in revenue, how much revenue is supposed to generate for you to be able to break even, it's much simpler. So first calculate this one. I will prefer that you calculate this one first. Take the break-even points in units, then multiply it with the selling price. This will give you the break-even point in sales revenue. Or you can actually go and calculate the marginal income ratio. Remember our marginal income ratio, this is your marginal income divided by total sales. This will give you 0.6 or 0.5. Then you go and say total sales divided by 0.6, and therefore it's going to give you your break-even points in revenue. So the two, if you calculate the two in one scenario, they will be a bit different by plus or minus 5% in terms of their difference. So other one might find that it's actually 1,600. The other one might be saying 1,550. So there will be a slight, because here you are using a ratio and here you are using the actual number of units. So there will be that difference in terms of the ratio. So I will say plus minus 1% in terms of the difference. So this is how we calculate break-even point. So it's your total fixed cost, break-even points in units. It's your total break-even points in units, total fixed cost divided by marginal cost per unit. And break-even points in sales revenue is total fixed cost divided by marginal income ratio, which is in percentage or in decimal. Or you can go and say break-even point in sales revenue equals to selling price per unit multiplied by number of break-even units. Then it will give you your sales revenue. So let's take a look at activity 6F. So please go on activity 6F, but before we do activity 6F, there is an activity that I want you guys, or an example that I want you guys to take a look into. Please go and perform activity 6D, identifying variable cost and fixed cost. So please do this activity so that you gain more understanding in terms of which one are my variable cost, which one are my fixed cost. So there are a number of items being given there. Then from there you'll be able to also learn in terms of which cost are classified to be fixed and which cost are classified to actually be variable. And then after that, I want you guys to also go and perform the following activity. Activity 6E, under activity 6E, I want you to do number 2, Roman figure question, Roman figure number 2, which is saying complete the following tables to say that you are identifying the cost behavior, whether the cost is actually variable or fixed, and whether this cost is direct in terms of production or indirect. So please go and do these activities, and then you'll also gain more understanding in terms of the variable and fixed cost. So the activity that we're going to do today is 6F. So I'm going to clear all of this. Please make sure that you highlight this and go and perform this activity. So the activity that we're doing today is activity 6F. So in terms of activity 6F, we've been given the following information. So I'm going to read it. So please make sure that you have the textbook on your side. So it says the budgeted information of the two business opportunity that John Geffer is currently considering investing in is as follows. So we have got, this is on page 273 on your textbook, chapter 6. So we've got opportunity 1, where we've got the sales of 800,000, which the selling price per unit is 400, and we've got the cost, which the cost is 640, which the total cost is 320, where this total cost, it's based on variable direct manufacturing cost of 256, which is 128. Variable indirect manufacturing cost, this is the same as non-manufacturing cost, which is 120, which is 60 rand per unit. Fixed manufacturing overhead, which is actually 80,000, which is the per unit, it's 40 rand. Sales commission 40,000, 20 rand per unit. Fixed administrative cost 144, and then we have got a per unit 72. The total profit that will be made is 160,000, which per unit is actually 80 rand. And then we've got opportunity number 2. Under opportunity number 2, we're having the same profit, all the same figures, sorry, not all the full the same figures. We've got the cost still being the same, the revenue being the same, but this time we're selling this other one, they're selling their product at 40 rand, so the other one is 400, so they're selling two different products, I will assume. And then your direct manufacturing cost is 80 rand, the other one, the direct manufacturing cost, it's 80 as well. Fixed manufacturing overhead is 240, this one is more. Sales commission is 80,000 and fixed administrative it's 160, and we've also been given the cost per unit. So the first question says calculate the break-even points for both opportunities. So we are calculating BEP. So I'll write that this is BEP. So I'll refer this as break-even point. So our break-even point for opportunity number 1, this side I'm gonna write BEP opportunity number 2. So the BEP, we know that for break-even points in units, it's equal to total fixed cost over marginal income per unit. So therefore, to calculate the fixed cost under this activity, we need to identify all costs that are fixed. So in terms of opportunity number 1, we've got fixed manufacturing overhead of 80,000 and fixed administrative cost of 144. So therefore, our fixed cost will actually be 80,000 plus 144,000. All of this divided by our marginal income per unit. So our marginal income will actually be our sales minus our variable cost. Sorry. So in terms of sales, so we are going to have our sales of 400,000 selling price per unit. Selling price per unit minus all our variable costs. So our variable cost in this case per unit, it's going to be 128 plus And then we also have got variable indirect manufacturing cost. So this is also a variable cost. So plus 60, and then again plus. Then we also have got sales commission of 20 rand. So therefore we're gonna add it because it's a variable cost, and therefore we can be able to calculate all of this. So when you calculate all of this, 80,000 plus 144, this is going to give us 224,000. And therefore here this side we're gonna still have 400 minus, so 60 plus 20, that's 80, therefore plus 128, that's gonna be 80 plus 128, that's gonna be 208. So therefore we're gonna have 224, all of these divided by our marginal cost per unit, which is going to be 400 minus 208. So 400 minus 208, so I'm gonna need my financial calculator just to actually identify how much is going to be our amount. So it's going to be 400 minus 208, that's gonna give us 192. Then here we're gonna have 192. So therefore our break-even point becomes 224,000 divided by 192. So therefore we have got a break-even point of 1167. So rounding this off to the nearest unit, we are actually working with units, so we don't actually have a half unit. So therefore if it's above 5, we're going to apply our rounding off, and therefore it's going to be now giving us a total of, so then this is going to actually give us a total of 1167 units. And then you're gonna do the same thing for this side. So for this side, our BEP in units, it's actually going to be the total fixed cost. All of this divide by marginal income per unit. So this is how you can write it in abbreviation and summarize it. And then here we're gonna then look in terms of what is our total fixed cost. So total fixed cost for this side is going to be 240 plus our fixed administrative cost of 160, and therefore this, all of this divided by our MI, which is going to be 40 rand, minus in brackets 4 rand, which is our variable for first variable, second variable plus another 4, and another variable cost that we also have, it's another 4. So therefore we are going to have 240 plus 160, that's gonna give us 400,000. All of this will therefore be divided by the fixed cost, by the marginal cost per income per unit, which is going to be 40 minus a 4 plus 4 plus 4, this is gonna give us 12. So this is going to give us 400,000. All of this 400,000 will therefore be divided by 28. So, but let's confirm 40 minus 12, that will be 28. So therefore we are going to have it being equal to divide by 28. So therefore we're gonna have 400,000 divide by 28. Sorry, 400 divide by 28. I'm not sure if I pressed everything right. Let me just divide by 28. So we then have our break-even points being 14,286. So we're gonna have our break-in being 14,286, rounding this off. So please make sure that you write that is it in units. So this is actually in units. So to be able to identify in terms of this whether this break-even point is acceptable or not. So one of the most important thing is you need to identify as well the total number of units to be sold. So for opportunity one, we are going to say 800. For this one, we're going to say 800, which is our total revenue. So this is our sales. All of this will be divided by 400, which is the selling price. So therefore, we are going to actually have 800 divided by 400. So this will give us 2000 units. So in total, units here, it's actually 2000 units. And then for this one, it's going to be 800. And therefore, this will be divided by 40. So this will actually be equals to 20,000. So 20,000. So one of the things that I just want us to be able to pick up, because this guy is trying to invest in one of these activities and it's not part of the activity, but I just want you to be able to pick up how is this very actually helpful. So what we are going to do now, we are actually going to calculate the break-even point against the number of units that are going to be produced and sold. So for the first one, we're saying that if we sell 1,167 units, we're actually going to be at break-even point, and the total number of units of what we're going to sell is 2,000. So let's say this divide by 2,000 and see in terms of how much percentage are we actually going to have covered before we actually make profit in terms of our total number of units to be sold. So therefore multiply this by 100%. So we're actually gonna be somewhere sitting at 58%. So we need to actually sell 58% of our stock to actually get to generate profit. Once after selling 58% of our stock, then we're gonna start making profit. So let's look at the second one. So it's gonna be 14,286 divided by 20,000, then multiplied by 100. So you will see that if you take a look at the two, you will see that for option number two, we actually have to sell 71% of our stock for us to be able to generate profit. And therefore, this then becomes a bit of an issue because now you have got a higher number of units that actually have to be sold. So therefore, for a company that if you want to actually earn a return or get to receive profit, therefore you actually have to actually go to opt for option number one, because you break even uh, at a lesser ratio of your total number of units that are actually supposed to be sold. So coming back to our lesson, so the second part says calculate the break-even point in sales revenue. So break-even point in sales revenue, just come and say break-even point in sales revenue. It's going to be equals to 1,167 units. These are our break-even points in units multiplied by our selling price of 400. And then you're going to get your total revenue. So that will be 1,167 multiplied by 400. So therefore our total is going to be 466,800. So it's going to be 466,800. So this is how much we need to sell, and this is how much revenue we need to generate for us to break even. Then you do the same for this side to say that BEP in sales, it's going to be 14,000 units, 286 multiplied by our selling price of 40 rand. Therefore, your total sales revenue in break even is going to be 14,286 multiplied by 40, giving you 571. This is gonna give you 571 440. So this is your break even in sales revenue. Then Now, this means that the company have to generate the following revenue for it to actually get to have no profit and loss. Once it produces anything above this revenue, they are making a bit of profit. But remember, there's still margin of safety, but it's not going to be covered in your activity or in your lesson. So I'm not going to focus on that. I just wanted you to understand what the margin of safety is all about when you come across it on the extra notes that you're going to try and get, or from your tutors, or from other learning material that you're going to go through. So the last part, it says construct a CVP for each of the two opportunities. So CVP. So what I'm going to do is I'm going to try and write this down and then use them later. So I'm going to clear that. So in terms of CVP, we've got option number one. I'm just going to write here. BEP in units, it's 1,167. In sales, it's 466,800. Opportunity number two, BEP in units, it's 14,286. In sales, it's 571,440 if I'm not mistaken. Let me just quickly confirm that. 440. So therefore, when you draw the graph, this is what's actually gonna happen. I'm just gonna look for something that will make this easy. Sorry about that, guys. Okay, when you make the graph, you're gonna have your fixed cost here, sitting somewhere here. So this will represent units. This will represent cost and revenue. So when there is no production, we expect this to be our fixed cost. So our fixed costs have been given there as a total of 224,000. So on this side, I'm just going to do a rough sketch. For number two, this is our fixed cost, this is our units, and this represents our cost as well as our revenue. So here we said that fixed cost was actually 400,000. So break-even point here, we are saying that it's 14,286, and our total number of units is 20,000. Here our total units is 2,000, and our break-even is actually 1167. So we're saying that the revenue that we're gonna break at here this side, it is actually going to be 466,800. And then this side, we are saying that we are going to break at 571,440 as revenue. So we're gonna try and put these together. There. So we're gonna have our variable cost on this side. Let me start this side. So we're gonna have our variable cost arising. So this is our variable cost, to say that once we start producing one unit, we're going to incur this, and when we produce the following units, this is where we're going to be at. So we're going to have this as our variable cost. So therefore our total cost, so this is going to represent our total cost, which is going to be the fixed cost, which is this, plus our variable cost will give us the total fixed cost. And then at this point, our fixed costs will be produced units will be 1167, and therefore our total cost will be 466,800. And then once we start selling units, if we don't sell any units, we expect the cost to be zero, we expect the revenue to be zero. So therefore once we start selling, therefore our revenue is gonna go up. uh, so our revenue, we're saying it's gonna go up. So this will be our total revenue. So at this point, our revenue will be the same as our fixed cost. So as our total cost. So therefore here we don't actually get to make any profit or loss. So therefore margin of safety, if we calculate it to be 10%, it will be somewhere here. I'm just gonna come here and then try to do a broken line. Let's just assume that it's 1,250. You will see that here the total cost is below the profit. The total cost will be below the profit, and the profit so below the total revenue, and the revenue will be above the total cost. So this means that here we're gonna have, let's say, something like 500,000, and here in terms of cost we're gonna have 480. So this will be our margin of safety. So our margin of safety is 1,200, so meaning that this becomes the part where if we fall somewhere in between here, we're still operating within margin of safety. So there are chances that we might not break even because of current changes in the market. But once we start selling above 1,250, we're seeing that we are outside margin of safety. We are now making profit. So for this one, this side, we're going to still have the same thing. Variable cost, total cost, and total revenue. So therefore our revenue is the same as our total cost at this stage. So you will see that here the margin of safety will actually be very high because we might be sitting somewhere here with somewhere around 16,000 units, and therefore this will be somewhere here. This will be somewhere there. So this is how you draw up your cost, volume, profit, or your break-even analysis graph. You only need the following item. You need your graph for total points. You need your line for your total revenue. You need your line for your variable cost. You need a line for your fixed cost. And you need your x-axis and y-axis where you're going to have your units, and then you're going to have your cost and revenue. And then you need to only point out three things. So there are three things that you need to point out on your graph. Your fixed cost, point out the fixed cost, that is how much. Point out the break-even revenue and cost, and as well as pointing out the break-even points in units, and then connect the dots. So this is where we get to break even. So please check this out on the textbook. It's much easier. So I think there is a graph on our textbook. I'm just gonna try and go there, and then this is the end of our lesson. I just want to show you with the one on the textbook. So this is how it would actually look like when you're drawing it from the textbook, or when you're looking at the textbook activity. So here you will see your break-even points, and here you will see your break-even units. This is revenue and in cost and revenue, and this is in units. And then these are quantity in terms of tons that are going to be sold. This is going to be a variable cost. This is going to be a fixed cost. So your variable cost plus your fixed cost will give you the total cost, starting from fixed cost, to say that if we do not have any units produced, we're still gonna have the fixed cost. So meaning that our total cost will still be equal to our fixed cost. So that's why it starts at this point. And once you start producing one unit, therefore it's gonna go up with those number of units as well. So this gap in between the fixed cost and variable cost, I will say that it represents the what we call the variable cost. And then you're going to have your revenue. Your revenue will start from zero, to say that once you have got 0 units being produced, it's also going to have 0 profit. Once units are being produced and sold, your revenue curve is gonna go up, and wherever it meets the total cost, that's your break-even point. So which you're gonna calculate it through the formula that I just shown you guys. So this is what we had to cover under this lesson. So our next lesson will be controlling inventory and overhead. So please make sure that you also stay tuned for this, because it's going to form part of your assessment, and therefore you will need more understanding. So under this activity that we just covered today, which is 6F. So I think this is the most forward and straightforward lesson in terms of understanding the break-even point analysis. So I've just explained everything that you need to understand and know. So I don't think there is any other activity after this one. So just revise this activity that we just did here, which is activity 6F, and then you'll be good to go in terms of the BEP or CVP analysis. Don't forget to do 6E and 6E number 2, as well as the other one that I did mention for you guys, that you should also go and do it. So this is the end of our lesson. Please enjoy the rest of your day, and make sure that you stay tuned for the next lesson, which is chapter number 7, controlling inventory and understanding how we manage inventory. Thank you very much.